Okay. Do me. All right. So we're going to go ahead and I'll just admit people during the live. So good evening, everyone. Good evening, good evening, good evening. My name is Kate Chapman. I am a realtor and certified probate expert at Keller Williams. And we are here with Power Your Legacy series. This is actually our last week. So we have discussed previously with Mr. Brommer, who is on the call, attorney Marlon Brommer. We have discussed wills and probate and estate planning. Tonight, we present to you Miss Simone Keys. Am I saying that correctly?
Yes.
Simone Keys. And we're excited to have her here. And Simone is going to play an intricate part in what this is as far as wealth building. So Simone is a CPA and she's located in Fort Lauderdale. Her background is, of course, tax and financial. She works as a tax and financial strategist. She's the owner of Kai's and Associates and an accounting professor for the past 10 years. She's also the president of the Broward chapter of Florida Institute of Certified Public Accountants. So we're excited to have you here, Simone. We thank you in advance for your time and also for all of the gems that you're going to give us tonight. So Simone.
Awesome. Hello, everybody. Nice to see your beautiful faces. And got it. Thanks for the invite. So, gonna be very respectful of your time, and I have a short presentation planned here, after which we will leave some room for any questions that you may have, and we'll just flow organically from there. So, as was mentioned before, I have a teaching background as a professor, an accounting professor for the past 10 years. I've had the pleasure of educating a lot of folks, students, on all things accounting. With that being said, when I started my firm, Keys and Associates, it was really started on the premise of not just doing accounting work or tax work, but really marrying education with the accounting practice so that my clients that I work with are very knowledgeable as to what's happening and not just saying, okay, here's the final product. So I'm hoping to share that with you guys tonight. So at the end of this webinar, what our goals are is for you to have a better understanding of the tax implications as it relates to estate versus legacy planning, estate versus inheritance, understanding what is a gift, and also understanding a little bit more about the tax implications of inheritance versus a gift, right? So first things first, I kind of want to dive into the difference between a legacy versus an estate, because, you know, we're talking about legacy here in the webinar, but a legacy could really mean quite a few things. While an estate is more geared towards protecting your assets, when we say legacy planning, it could involve spiritual, intellectual relation, and social capital that we're passing on to our heirs. So I don't, when we say legacy planning per se, we're looking at, okay, do I want to pass this on as a gift? Do I want to put this in an estate? Do I want to have my family member have me sign on as a co-owner of things, right? So there are different ways, of course, in which you can pass things on through your legacy, right? So what I'm going to touch on tonight is maybe some of the most common ones, which is, of course, a will versus an estate versus a gift. So those are the three ones that I'm going to focus on tonight, which I think is very relevant to us and to where we are right now. So let me see. So first, inheritance. And inheritance tax, and when I talk about inheritance here, I put in parentheses a will, right? So we're passing something on. When we're passing on items or assets through an inheritance, typically what happens is the individual who is receiving that inheritance is the one that tends to be taxed or is responsible for paying the taxes. Now, typically, there is no state, federal tax from the act of passing on the item. Where taxes usually come in is probably a little bit later when you decide to sell, or if that inheritance is earning money, right? Which we're going to look at a little bit later. Now, an inheritance tax is more of a state level thing. There are about 6 states that implement an inheritance tax. Unfortunately for us, Florida is not one of those states, right? So a lot of the times when we're dealing with inheritance tax for in the state of Florida, that doesn't really exist. But depending on what you do with the inheritance, there might be some implications there, and we'll talk about that. Then I want to talk about an estate, right? So Marlon probably discussed doing a trust or having an estate. Now, typically with this, the tax is levied on the deceased person's assets. So whoever is responsible for that estate or that trust will typically, of course, gather up all the assets. The taxes are imposed prior to the distribution to the different folks. Now, I want to point out that in 2024, typically an estate will be taxed if it's valued over 13.61 million. So as you could see here, that kind of eliminates a lot of people, right? So unless you're at a certain level where you're sitting in a couple millies, you typically will not necessarily have a tax there, okay? So that's very, very important to know. Now, here's where it gets fun. While the trust or the estate is not taxed unless it exceeds that threshold, that $13 million threshold, if the assets within it are earning income, for example, what if somebody left you a house, it's in a part of the trust, you got some stocks, and I can't hear. All right, so you could let me know if that was a question. So typically, what would happen is if you have a trust in place, and let's say, for instance, you're not able to touch the actual asset, but that asset within it is earning some type of income. And I think these are probably the three of the most common. You could get a house, per stipulation, you can't sell the house right away. Maybe somebody's already living in the house, you're getting rental income from that property, then that is tax. If you got a bank account with a certain amount of cash, there's interest or dividends being earned on that, then there could be a tax at that level. However, trust beneficiaries do not pay taxes on the actual assets within the trust, okay? Unless we're above that $13 million threshold, okay? And if you're there at that 13 million, you can let me know, right? There are accountants, CPAs who just handle this type of tax and who specialize here, okay? So just be mindful of that. And I always recommend to always, again, with your lawyer and your CPA, get legal advice in any capacity before you even touch these things. Now, granted, my accounting practice, we don't necessarily deal with estate taxes. We deal more with the overall tax planning. If it's very in depth, and I think definitely if you're above that 13 mil, you'd need to definitely see an accountant or CPA that specializes in that, or a lawyer. Okay. So let's talk about inheritance versus gifts. Inheritance versus gifts. So let's define what is inheritance versus a gift. Now, an inheritance, when I think of an inheritance, I'm thinking of more of a will. All right, not necessarily something that is established within a trust, right? As I said before, the act of inheriting something is not taxed, but if what you inherit later generates income, then you're looking at potential for capital gains tax. And I'm not sure if you've heard of the concept of capital gains tax, but capital gains tax are usually taxed at a different rate than your normal taxable income or your ordinary taxable income rate. So in most instances, it tends to be a little bit higher. Okay. Now, what if I decide to sell a property that I inherited? All right. So you inherited a property and you decided to sell. It says that if you're here sell an asset that they inherited, any profit could be taxed at the federal level, either as a long-term or a short-term capital gain, depending on when you dispose of the property. If you've held the property for more than a year, typically we consider that a long-term capital gain. If you got the property and you decided, hey, I don't want this, I'm going to try and get rid of it as soon as possible, selling it less than a year, you're looking at a short-term capital gain. So how do we determine the tax though? Okay. It says here to determine if the sale of an inherited property is taxable, the first thing we want to know is what is basis. This is like our IRS lingo. And that lingo is saying, what do you have vested in the property? It says the basis of property that is inherited from a descendant is the fair market value of the property at the time of death. Okay, so very, very, very important to note, right? Now, I gave an example here. Let's say grandma bought a house in 1980 for $150,000. She passes away in 2022 and you inherit the property. At the time of her passing, the property was worth $600,000. You were able to sell that for $750,000. What is your gain on that? Well, based upon the IRS rules, then this would be a $150,000 gain. Okay, so this is how that gain is determined. So when we look at some of this later, you'll realize too that typically you want to when we look at gift versus inheritance versus putting things through a trust, you want to, again, this is where your legal counsel and your CPAs come into play to make sure that you're doing the best thing for your family, the best thing for your legacy and your planning, right? So this is typically how that's done. Now let's look at a gift, because I feel like sometimes when we have an elderly person in our family, they may be sitting on a few assets, they may or may not necessarily have a will or a trust in place. And then you say, hey, maybe they're on limited time. And you're like, okay, let me put my name on these. Let me do it as a gift, just so if anything happens to her, somebody else could come in and step in, right? So let's define what is a gift. A gift is any transfer to an individual, whether directly or indirectly, where we're not getting full consideration. So if we were to sell this in the public, it would be a completely different price versus what I'm giving it to my family member for. Now, gifts are a little bit different. How this works, a gift tax is paid by the donor, which is the person who is giving the gift. Now, again, this doesn't come in unless you're making or your gift exceeds about $12 million. And I'm approximating that because I think that has changed, right? So most people, again, don't necessarily fall in this, unless you're sitting on a chunk of change, right? Most people don't necessarily even come within close of that. However, here's when it becomes reportable. If the person is giving you something worth more than $17,000 in any 1 year, they must include that on their tax return. Okay, so all we're doing is just putting an extra sheet on the tax return to say to the IRS, hey, we're giving a gift. And what the IRS does is they keep track of this to make sure that it doesn't exceed that 12 million, that threshold for the year, right? So again, you could give as much as you want. The donor will get taxed if that gift is above that couple $1 million threshold. Typically, the person who's receiving it will not have any implications there. Now, the general rule is that your basis in the property, if it's a gift, is the same as the basis of the donor. right? And this is where it gets a little hairy. Let's look at the scenario that we just looked at with grandma. She bought the house for 150. By the time she passed, it was worth 600. You sold it for 750. Well, if she gifted you that property before she passed, then your basis in that, your stake in that is that 150,000 that she originally paid for that asset. So when you turn around and sell that asset, you're looking at a gain of $600,000 versus if you had put this in a trust or put this in a more structured way and passed it on, then you would have been able to step your basis up to the 600,000 and only report a $150,000 gain. Make sense? So very, very, very different. So a gift, if it's a gift, your family is giving you a gift, you may want to hold back and say, okay, maybe I want to open a trust with this, or maybe I want to structure this a little bit different so that when, in the event of you passing, you have a better basis in the property. So when you then sell it, you're not looking at paying this enormous tax as it relates to this. So I think that is actually very, very important to know when it comes to legacy planning, because I think this is where, as culture, as folks, we tend to think that we are, doing ourselves a favor. We're trying to be proactive if anything happens to our loved ones. So we go out there and we say, hey, let's put our names on this. Let's, let's restructure the assets before they pass. And you're thinking about saving money in the short term by not necessarily getting a lawyer to structure it properly. And you're like, oh, let me just go to the bank and just transfer these all as gifts. Versus let me hire Marlon to have this done. And Marlon may necessarily charge you a little bit more. Well, it comes around and it bites you, because now if and when you decide to sell this, you've now put yourself in a situation where you have to report so much gain. So the last thing I wanted to talk about here is, well, does this necessarily mean that having a trust or a will is better than giving or passing on your legacy through a gift? And typically, if you talk to most CPAs, they will say yes. It says if a trust is structured properly, it will have tax advantages for your beneficiaries. Assets that have gone up in value will get what we call a step up in basis, where you don't have to report what it was purchased for, but what it's worth at the time of the passing of the person. All right. And that means your beneficiaries will, of course, pay less in capital gains taxes. It says assets that are gifted do not receive that step up in basis. And you will actually have to report to the IRS that, hey, grandma paid $150,000 for this property. I got it as a gift. I'm selling it for $750. You have a $600,000 gain there. And again, this is not just ordinary income tax rate. This is capital gains tax rate. So this is a lot higher in a lot of cases. And, if you could hold that property for longer than a year, normally we recommend it because it's actually less in capital gains taxes if you've held it for more than a year versus if you've held it for less than a year. Another solution could be, hey, if I get this asset and this asset is being gifted to me, let's say you did not structure it properly, well, can I make this an investment property in the interim, right? In some way, shape, or form, and then I will just then report rental income on that. So there are actually some ways, and I could even go back to this. Same scenario with grandma. Let's say, for instance, we did not transfer this asset properly through a trust. And so because of that, we're now looking at a huge, if and when you sell, you're looking at a huge capital gain. And you're like, I don't want to absorb that gain right now. I don't want to pay taxes on $600,000. What some of our wealthy clients will do is they'll say, all right, let me then convert this into an investment property, rent it out for a few years, right? And consequently, when it becomes an investment property, I would now opt to sell it, but maybe I will sell it in a 1031 exchange, right? And a 1031 exchange basically means you could now sell that property, and within a certain period of time, the IRS gives you 6 months to find another property of equal, basically of equal value of the property that you're selling, and then you will not have to pay the taxes on the gain. So there are some loopholes and some ways in which you could structure this, wherein you could delay, not necessarily avoid, right? But you could delay some of the tax implications when it comes to getting a gift, especially if you were not knowledgeable on how to transfer it correctly, and you may not have set up a trust. And now you're looking at, well, I'm sitting on a potential huge tax burden that you don't necessarily want to bear. Guys, do you have any questions for me so far?
I have a question. What's the approximate, I know you can't say exactly, percentage for capital gains?
You know what? I think it's right now 30%, and it's, let me tell you what 2024 is.
And also, is capital gains, I'm so sorry. I'm sorry. Is capital gains different for business, or is capital gains just capital gains whether or not it's a gift or something you received
No,
in?
it's usually it's set. It says, so right now we're looking at capital gains at about 0 to 15%. And a lot of it is dependent on what your income is. So you have, of course, short-term and long-term, right? So short-term capital gains, according to the IRS, are subject to 0, 15, or 20%, depending on your income, where most people will fall in the 15% rate. All right. Let me see if they've issued 2024. Yeah. Nope. I don't see much changes here with the 2024. And not only that, for when you're thinking about capital gains, typically this is at the individual level, right? Because when businesses sell, the gain or loss is a little bit different there, right? So when we're looking at capital gains, it's usually we're looking at on an individual taxation level, right? Gains or losses on business assets are a little bit different, right? Which is why I said before, there could be some benefits in converting your property to a business asset prior to sale, right? Instead of keeping it, so renting it out, right? For a period of time prior to selling, right? So there are some benefits to doing it that way. And I hope I answered your question. I was actually trying to dive into the 24. Yeah.
Simone, on that note, with regard to the long-term versus short-term capital gain, is it better for someone to hold property in the long term to minimize the taxes as opposed to selling it in the short term, or vice versa? Which one is it?
So long term is usually better. And again, long term is anything less than greater than a year versus short term, which is less than a year. Now, even though the capital gains rates are still within the 0, 15 to 20, how it's calculated on the actual tax return, long term versus short term, gives you a better benefit when it's a long term capital gain. Yeah. So I recommend holding it a little bit, either way. And at that point in time, maybe a year again, and then consider selling, talking to your CPA at that point to see what are some options that you may have. Again, a lot of people don't know about the 1031 exchange option. And I think that is something that could be very, very useful and valuable to us. Wealthy people have been doing it. They've been doing it for a very long time, and they've been deferring taxes on properties that they've been selling for years and years and years. So instead of, again, selling it, having the cash, if you know you're going to buy another house anyway, why not just structure it in such a way wherein you could treat it as an exchange of one to another versus recognizing a gain on a sale, right? 1031 exchange, I know my realtors are on here. So your 1031 exchange is a little tricky because you have to have a broker involved wherein the funds don't go to you, it goes to a third party. The third party will hold the funds. And then when you buy your other property, they're like an intermediary and they would kind of buy that other property on your behalf. So in essence, the IRS is like, if there's a $600,000 gain, you will never touch the money in your personal bank account. It will actually go to someone that will hold it for you, right? And then when it's time to buy the other property, they will do that. So then you will avoid paying the taxes in between. So that is a very viable option that I think a lot of people don't talk about when it comes to this. So again, I just think that when it comes to trust, a lot of the times with the trust, the threshold for the tax is so high. Your common everyday man, they're not at 13 mil. So hence why we're like, get a trust. It works out, it's way better. Versus you having to get a will, goes through probate, and when you're inheriting, then there's an issue there, right? So very different. So that is, let me see if I think I stopped sharing with you. Let me just make sure I'm on point here. So again, that is the end of my presentation. If you guys have any other questions, you could definitely let me know. I tried to keep it short and sweet, but I am going to leave you with my contact information. And, and again, I do not specialize in trust accounting by any means. There are CPAs who are licensed in this area. In my practice, I deal with a lot of individual and business, particularly business. So C Corps, S Corps, tax planning around that, especially if you're a small business wherein you may have income flowing through from your business onto your personal return, and just finding ways to kind of mitigate that when it comes to tax planning. That's usually our specialty. But again, there are a lot of CPAs there, and I could even recommend some to you if you're going the route of doing a trust, or you think you're going to hit that $13 million threshold and you're like, okay, I definitely want to talk to somebody to handle this, right? We could definitely refer you there. But I think for us, the gift tax versus the trust and inheritance is the ones that may be more relevant to us, as it's more, common to the everyday man. So this is my contact info. My firm is located in Plantation. You could always call, text, reach out via email, and I would happily discuss anything on the slides today or anything else business related that you think you would want to discuss.
Awesome. Love it. Love it. Love it. And you were talking about the 1031 exchange. So I know now if I have someone with a property, Marlon, I'm bringing them to you, and and also to Simone, because there's so many strategies with this, and the loopholes that you were talking about. Because I know someone right now whose dad passed away, and he's going onto the property, not sure what he would like to do. So
Okay.
Yeah,
it's a viable option. And there's also like qualified opportunity zones too, which is a big one. I feel like that doesn't get talked about a lot. And it, I'm not sure how we could necessarily tie that into to here, but if you're buying within those zones, there's a lot of tax benefits there as well, right? So qualified opportunity zones are areas where the IRS or the government has said that they want to develop or put more of an infrastructure there. And so they're trying to get folks to invest in these areas. And so if you invest in these areas, they offer a lot of tax incentive and perks. Like, Jacksonville has a whole bunch. I've had clients buy a lot of properties in Jacksonville and sitting on it and getting a huge tax perks there.
yeah. And Fort Pierce has Fort Pierce.
Fort Pierce, yeah, absolutely. All right.
Okay, does anyone have any other questions for Simone?
You guys are awesome. Quiet. And I mean, again, we're very approachable. So if you've thought of something after the fact, definitely feel free to reach out. I'll be happy to answer any questions that you may have.
Awesome, awesome. Thank you. Now, Simone, I know we were talking about also being your own bank. Do you want to tap into that or we can save it for the next series? What do you think?
So
I was excited to get to that part
that's
too.
the thing. I know we talked about. So what I can tell you is this. So there's this misconception about that. So being your own bank, it's amazing. So what it is, just by definition, is wherein you open up a certain type of life insurance vehicle, and that vehicle will then earn value over a period of time. And you could then use that vehicle as collateral against a loan from other institutions. So, sometimes you may be looking at wanting to get maybe a loan. You could lend from yourself if the vehicle has enough assets. So some people think, oh, let me open up a policy and then I'll be able to be my own bank on that. No, it takes quite a bit of time to earn, or what is the word that I'm looking for, to build up the value, I guess, so for you to be able to pull down on it. So it's not something immediate. Normally when we say being your own bank, I'm telling my clients, hey, you want to start now so that maybe in like 5 to 10 years you could actually be your own bank, because that's about the average time that it will take to build up the value that you could borrow down on yourself. But in the interim, sometimes what some financial institutions will do, if you're looking for a loan, they're like, well, we want some collateral. Well, and you might not necessarily have anything else as collateral, but you could say, hey, I have this policy here that is building value. I'm going to give this to you as a potential collateral or an asset that you could use and hold on to should anything happen to me. You have this insurance vehicle. So that is, it's a powerful tool. It is a very powerful tool. I will not negate it. But I think, this is for my visionaries. You're thinking way ahead. You know where you're trying to be. You know that in 10 years, I want to be a mogul in this area. So I want to definitely have my own bank. You start now. So that in that time, you have that. Now, it's very important to also note that most life insurance vehicles there's no tax there, because the IRS does not give you a tax deduction for having life insurance, because they don't tax your life insurance. When you're awarded a life insurance, those funds are not taxable, right? So some folks will say, well, I'm putting all this money away in life insurance and I can't get any immediate benefit from it. Well, it's really more of a long-term, again, more of a long-term thing. So I would recommend, there are different types of life insurance vehicles that you could use to be your own bank. And that is where my life insurance folks would really come in and kind of talk to you about which one would be best for you. But from an accounting perspective and a tax perspective, there's really not any tax implications, which is good. It just means that you have to really just plan ahead, though. Yeah.
Simone, would that work if you did that, say, for a child? Could you open one of those life insurance policy for a child, and you're planning ahead that by the time they get to a certain age, they'll be able to pull from it to purchase their first home or make some kind of big purchase? Would that work?
Well, it wouldn't be your own bank, but using the life insurance vehicle, because of course with kids, you do a whole life policy typically, and that will build value over time. And then of course, when that child gets to a certain age, you could definitively pull down on that and be able to use that. Now, I have some clients wherein they use like vehicles like Roth IRAs to save for college versus like a 529 savings plan. Or they may say, because again, a Roth is not taxable, right? So two things, I have a 3-year-old. So two things I did when he was born was, one, I made sure I opened a life insurance, a whole life policy. So, he's so young, it's cheap now. I'm locked into a cheaper rate. And then, as he gets older, when he gets 18, the value in that, I could then hand it over to him, gift it to him. He's already sitting on a couple $100,000 by the time he's 18, and he's good. But another thing that a lot of people don't know is that you could also do a Roth for your children. And because that is tax-free income, you could pull down on that when your child is ready to go to college, right? And use that as a vehicle to pay for college. So Roth, you could put like $6,000 a year. And if you invest that Roth properly, and some people don't, and maybe this is like a whole other webinar, but if you invest that Roth properly, because you could self-direct your own Roth. You could buy a house with your Roth. I have clients who buy cows, farms, right, their Roth, right? They do that. And it builds a lot of value. And whatever that Roth earns, if you buy an investment property in your Roth, you'll never get taxed on anything in there. You could sell it short term, long term, any term. There's no tax because it's within the Roth vehicle. So you can really build some wealth there. And I think a lot of people leave that on the table because most people talk about 529 college savings plans, but you don't have any control over that. And let's say your child decides that they don't want to go to college, or they don't want to go to college that you want them to go to. You could get taxed on that money if it's not used for that specific purpose. With the Roth, that is not the case. If they decide to not go to college, they're like, oh well, let me just pull down on this Roth and take a nice vacation somewhere, so you have different avenues. So this is where I would normally come in with some in-depth tax planning with my clients, because we're probably on social media and you hear people saying, oh, you could pay your kids. Yes, because the kids have to have earned income to have a Roth. So if you have a business, you should put your kids on payroll. They have earned income. What do you do with the earned income? You open a Roth IRA. They don't need to see the money. You don't even tell them that you have it, right? So that the kids have their own account and it's building up whatever you pay. And so that's how you really build wealth. And again, legacy planning, right? That's how you really, really start to set your children up for a different trajectory than the one we were on. Because again, I wish I had a whole life policy that my mother was gifting me at 18. And I'll be like chilling right now. But you just don't know. And of course, you have wealthy people who've known this for years and years and years and years. When you think about, the Rockefellers and so forth, they are their own bank because they've had these insurance vehicles for so long. They've just been pulling down, and when another child is born, they just keep getting another insurance vehicle. So then it's just like they have this perpetual wealth that just keeps going, going, going. Wherein, sometimes you have folks who are just like, well, I don't want to give no money when I'm dead, I want to spend it all now. It's really a mindset type of thing, and education, to be able to do these things. So I highly recommend, especially if you have a business here, that you see someone and talk about ways that you could really leverage the business for your family overall. Because it's so common for us to have a business and we're working the business every day. And then you're like 10 years pass and you're like, where's the money? What happened to it? Like, I've just been stuck in the weeds, like in, out. And like, you've been working all this time and you realize that you have to keep working to keep everything going, because it's just like money in, money out, money in, money out. And with my clients, we nip that in the bud right off the bat. And I do that with my clients through like profit first. So that principle is any money that comes in, 10% off the top of the gross goes to your profit first account off the top. So if I get 10 grand one week, $1,000 is going into a separate profit first. And that account is solely for the purpose of building wealth in other areas. That's it. So I have my CPA firm. If I get $100,000 per year, 10,000 goes in profit first. I'm using that 10,000 to buy a rental property. so that I could have residual income in future. So then when the time passes, you can't say you don't see the money, because now you could actually retire because you have these properties that you've bought while you've had the business that will now give you the income that you want to have at a later date. And then now you have all these properties that you could now pass on. So again, there is a legacy there, right? So again,
That was the blueprint.
yeah, that's a blueprint. Like you have to. If your business now is not funding other investments, then what's the point? You're just gonna be working, money in up every day, and then you get old and you're like, "Ugh, I work so hard. Where is it?
Mhm.
Where is the money?" So 10% is rigid. And some clients, depending on the profit margins, I will say, hey, do 5, but you just have to say, this is for other investments only. Buy a storage unit.
Yeah.
Storage units do really well, guys. Especially for people who hoard stuff. Storage units are amazing. You think about it, but you really think about it. It's just like a building with AC. Nobody's there. Yeah, you have a little security, but think you get storage. Have you rented a storage unit lately? I tried to rent a 4x4. That thing was
They're-
like $150. I couldn't believe it.
They're so expensive.
They are so expensive, but guess what? They're packed.
Mhm.
Like they go like this. So storage units are actually not bad. And I mean, I talk about cows. I guess why I have a client that bought some cows in Idaho. Guys, cows aren't bad either. Livestock isn't bad either. There are tax benefits there. And I'm not talking about, again, what he did was he bought it from a particular farm. They're raising these cows to be like Wagyu beef. It's not like regular beef. So you're thinking about buying a cow for like $1,000, a calf. It grows up, it grows. Now this cow is worth prime meat because you're feeding it good stuff. It's a lot of money. You could sell a cow 10,000 plus. And then you buy some more cows, and maybe they might have some calves, and then here you go. So I feel like we need to think outside the box a little bit, and that's, again, it's not something that we do a lot. And so again, when we talk about the firm and marrying education with accounting, that's really what I mean. Like we actually have webinars, like me and my clients, okay, I might bring in somebody who knows how to sell direct IRA, so they could teach you like what you need to do, right? And things like that. Because there's a lot. I don't know everything. I could tell you out front, but there is a lot out there that we could do. I think most people are stuck on like, oh, I have to invest in stocks, etc. But there's really so much more vehicles that you could use to pass on to your family. So I would love for you guys to explore that a little bit. I know I talked about inheritance, trust, and so forth. That is really after you've had the assets to put into these vehicles, correct? So you have to be savvy first to build the assets that you want to put into these vehicles to be able to pass on, right? So that's really where it begins, right? So educating yourself on what are some things that I could, whether it's a Roth, whether it's a regular 401k, whether it's just through my business, passing down my business, how I want to pass down my business. I know when I worked with Marlon on my trust, I need to come back to talk about the business side, because I did my personal trust. But as a CPA firm, I think my client list is very valuable. So anything that happens to me, if I'm passing on my clients, I want my kids to benefit from that. I would want them to earn some of the income over the years from these clients that I've earned, right? That I'm passing on to somebody else, right? So when I create my plan, that is a stipulation, like my kids should get my percentage over X amount of time, right? So that they could do their thing. So that's why I go hard. Go hard. So so I have a nice, practice that I could then pass on should anything happen to me. So that's one of my ways that I plan to protect my legacy with my kids.
Exactly. And last week, we actually talked about having a personal trust and a business trust, Marlon, right? And so you definitely should have two separate trusts between your personal and business.
Is it a trust though? I think you called it something else, Marlon. Is it like succession planning?
Succession
Okay.
planning.
Yes.
So it all depends on how complicated you want to make things or how simple you want to make things. So I'd always recommend starting off with your personal trust, right? That'll take care of your personal wealth, the wealth that you're creating through your IRAs and your life insurance policies and all that good stuff. But at some point in time, it might get a bit wheelie, right, with regard to how you hold certain assets like real estate or several businesses or so on and so forth. Now, there are some who you can structure it real well just through corporations and succession planning. Or if some folks want to go the route of actually having a trust that would hold the corporation, and I think often that's expensive, unnecessary. But if it's something that you're interested in doing, that's an option as well. But as long as you have good, strong, structural succession planning on the business side, it should be fine.
Okay. So walk me through this. I have a client who's looking to purchase a property. We close on the property. And now post-closing, they don't, let's say they don't have life insurance. But I take, I refer them to a life insurance agent or to an attorney first or a CPA because I want to see how this all ties in so we can have more like a step by step. Like, who should they seek first? The attorney first, or the CPA, or the financial advisor?
I'm not sure if there's an order to it, right? So it really boils down to their specific need and what's in front of them at that specific time. I think they should very well see all three or even more, people to have a good, well-rounded perspective, grounded in what they want to accomplish. But absolutely, if you have someone who purchased property and they're uninsured, have no basis there, you want to definitely have him sit down with someone who can talk to them about putting together a structural plan. It doesn't have to necessarily be an attorney. It could be that life insurance agent or financial advisor, and or the CPA. And absolutely, at some point in time, that they need to put that property in a trust.
Yeah, I'm gonna counter on that a little bit, Marlon.
Sure,
Say,
absolutely.
I don't know, I saw a hand. Personally, though, I feel like the attorney should be last. Marlon's gonna be like, what?
I didn't put myself
You
first
guys
in
are
that
the
one,
most
so I'm perfectly fine.
expensive.
I'm
Not
perfectly
only
fine.
that, when when I go to Marlon to do my trust, I think I should already have assets to put in. So if I did not necessarily see the financial advisor yet to build or establish the 401k, and these other vehicles, then by the time for me to get the trust going, I won't necessarily have much to put into the trust. And what will now happen is I would have to now get these vehicles and then come back to the attorney to add them in at a later date. And I mean, depending, and correct me if I'm wrong, Marlon, I know some attorneys, they have a cost to that. So you could have your original trust and then, you could acquire more assets over time, as you get older, you're building more wealth, and then you want to add these into the trust. Some attorneys, I think they charge you to modify your trust as you go along as well. Not all.
Yeah, very good point. And I'm gonna counter your counter, right? So I would actually say, I would be the first person you want to sit with, right? And I'm not saying that because I want you in my office. I'm saying that because if we don't get that will in place, if we don't get those guardianship documents in place, if we don't get that trust in place, right, irrespective of the fact that you don't have any assets, there are some very serious repercussions to that, right? I sat with two clients today that luckily she had a power of attorney in place for her dad, right? And now she's in a difficult situation that she can navigate primarily because that document is in place. So I would highly recommend that I would be the first stop. Yes, there are some law firms that make it an additional cost to modify the trust and so on and so forth. We don't, right? Once you've established the trust, you can always come back to us, as you know,
Yes.
and make any modifications with regard to the trust at any given time, right? So it's a one and done. We support you for the rest of your life. If you're gonna do something crazy and a separate trust, a land trust or a CRT or ILIT, I didn't want to quiz you on the CRT or the ILIT strategy with regard to taxes, right? But that's a very effective way to avoid taxes with regard to real estate, and coupling it with the life insurance policy, and actually replacing the asset with the actual value of the asset without it, and you can actually liquidate the asset and not incur any taxes and kind of avoid taxes that way. But there are different things that can be done to the trust, and we will do that for you for free for the rest of your life. So I should be the first stop.
Okay, Julia. I love it.
Hey, thank you for taking my comment here.
Thank you, Marlon. Yes, thank you.
Yeah, there's a lot of good information here tonight. And I wanted to share a little bit too. Now, one thing I went to today, I went to this joint tax and estate planning seminar, but they were talking more so, and you've probably heard of it because a lot of us in the South Florida area, Tri-County, go to that. And it would, had the Community Foundation of Broward, had United Way, and the Jewish Federation, all sponsoring that whole event. It was held down at First Baptist Church of Fort Lauderdale, downtown Fort Lauderdale. But anyway, got a lot of great information about things that you do to protect yourself from the taxes. And a lot of things have been changing, based on all the things going on, just before pandemic, post pandemic, this the wars between Israel and Hamas. These things are all affecting us, not just on this soil here, but across the world. It's a global economy. So that's affecting some of the legislation around taxation and estate planning. But nonetheless, I'm not going to get into that per se right now. But I will say that, and for those who don't know me, I'm Julia Lewis Spann, and I've been a financial services professional for a few years. So the thing about this, and I do agree with both Marlon and Simone and Kalila about this. It's a multiple discipline approach, and we should be in continual. It's a joint effort, and one of the things that we do is it's almost like a team of consultants that we are all collaborating on how to best structure the plans for the future for that particular business owner or family, our head of household, or whatever the case may be. And so one of the things in insurance that I do is we do get the big picture. We get input from the attorney, from the accountant. I have clients that's who referred my clients to me were their accountants, because the accountants are constantly counting all those, being counters. They're constantly counting and, seeing what assets they do have, because they're reportable, assets, and the income and the, profit loss, all those things, their quarterlies, whatever. So knowing that's something that I, as a financial services professional, have to factor into the plans that we're putting together from an insurance perspective, because we need to know what kind of assets do you have that we need to protect, you know? And for a business, we get the business valuations, you know, we get all kinds of things. We see how many partners, we see what the structure is of that entity or of that corporation, what it is. And then that also helps us when it comes to what their attorney's doing, which is maybe the buy-sell agreements. But when they come to us too, we have templates that do help clients to see what their needs are and how they should instruct the attorney on the elements that need to be included in the trust or the agreements or whatever. We don't draft them ourselves. We don't file tax returns ourselves for the businesses or the families, but that's what we do. We're doing a collaboration, and we do help with, you know, templates and things that give people an idea in layman's terms as to what they need to be looking for when they do consult their CPA or their, you know, attorneys. And everybody really who's serious about their future and their legacy needs to have that. So it's a multifaceted approach. It's collaborative, and it's not one versus the other. It's like all together, and it's fun. It can be fun. So.
Yes. Anyone have any comments about that? No? That's a lot of good information, guys. So let me ask you all this, the three experts on here, Marlon, Simone, and Julia. When we talk about the great wealth transfer, and I know you all have heard of that, what are some ways in your area of expertise do you feel like we lose our wealth before it's even transferred? No transfer because we lose our wealth. Like, could it be nursing homes, you know, without long-term care?
Oh, yeah, you lose your wealth. You're right. Okay, it can go just like this. You know, you just need one good illness, right? That's like top reason. Medical bills, medical expenses is the number one, like in the top 5, if not the top 3 for bankruptcies. A medical illness, a death, divorce, those types of things can lead right to bankruptcy. So if there's some protection there, there are different ways, there are different forms of insurance. And this is one thing that I'll say, kind of like the gospel of life insurance, so to speak, is it good news these days. There is help for almost anybody, even if they have illnesses. They could have mental illnesses. There is an insurance plan policy for you. You know, there are people with diabetes. There are special plans now in different companies that are willing to take that risk and underwrite you and give you the protection you need. I've done people who've had, what is it called? The sickle cell. There's a plan for them. There's a plan for people with these different illnesses, even if they've had cancer. You know, we're talking breast cancer, you know, or different types of cancers. There are certain stipulations, but there's still hope. And that's the point that I want to say, is that if they fail to have some kind of life insurance, and that's the reason why people do lose their wealth, because they're not acting, they're in fear, because it's what to say, false evidence appearing real. They don't realize that there is a solution. And so education and knowing that there is something for them, and acting upon that, you know, and they say, oh, I can't afford insurance, but you can't afford not to have insurance. So.
And I will piggyback on that and say, from the tax side, there is a vehicle called a health savings account that I feel like a lot of people don't take advantage of, but an HSA is where you are able to have a regular insurance policy, but above and beyond that, you could actually set aside pre-tax dollars into this health savings account. And you're able to now write off some of those medical expenses wherein you would not necessarily have been able to do before. And one of the good things I like about the HSA is that that can also be self-directed. So your HSA could own property, other types of assets, and can grow over a period of time, and those earnings become non-taxable to you, and you're able to get the tax savings right now. So a health savings account is a very powerful tool. It's used by, tend to use by my wealthy individuals. There are limitations as to the amount that you could contribute on an annual basis, whether it's an individual or family. I think if you're an individual, it's 3,008 versus a family, you could put away about another $7,000 a year. But you could use that, those funds that you're putting away, to invest in other assets, and it could earn income that becomes tax-free income to you, and you could pull down on that for your medical expenses at any point in time. So it is again, huge, a huge tax saver for some, especially if I have my business individuals here too. Mhm.
And I would add that obviously wealth, I think, is lost at the probate court. It's a huge opportunity for us to expand our generational wealth, and for one reason or the other, we tend to miss that opportunity. And I can't tell you how many times I've seen people that literally abandon properties. I've this one client literally walked away from a seven-figure bank account because it was a situation where the person who gifted the monies is deceased, and the person who was supposed to receive the gift is deceased, and the person who might inherit from that person don't want to go through the work of having to get two probate issues taken care of, right? It might be lengthy, it might be long, but you're talking about seven figures, right? So, and there are times when it's just frankly impossible to do, right? So I think what's another missed opportunity, if you can't really quantify it, is the lack of institutionalizing legacy planning in our homes, right? So talking about the need for us to think beyond just our own generation and the generation after ours, and instilling that in our kids. Yesterday, my 10-year-old is going to be 11. He came to me and he said, look, Dad, I'm going to be creating this game, and I want to create a corporation and start marketing it. So I want you to help me with that, right? Those are the type of discussions that we're having now in this household, right? And he's thinking beyond 12, right? So we have to really capitalize on that. I shared my story of how my family went through thousands of acres of land, and there's nothing to speak of, right? So huge lost opportunity. Can you imagine where it would be today if we really just stood by that? So again, we just don't know. We know how to create it, we know how to buy cows, right? We know how to do all the good stuff, right? But we don't know how to transition that wealth to the next generation. There's this concept called family constitutions. I would highly recommend you Google that and see what that is all about. Similar to the US Constitution. And very extremely wealthy families have implemented family constitutions. So those are your families with family offices, literally run by attorneys, accountants, financial advisors, right? They have what is called a family constitution. You and I, just as how I suggested that you can still come to my office if you don't have any assets, you and I need to implement the family office concept today, the family constitution office today, right? Primarily because we are building the framework for success, right? When you come to my office, I give you the framework for success. What you do with it is up to you, but you have to start building that framework.
Can I add something to just what everyone was saying too? Marlon, when you started talking about the probate process and then the land, it just brought me home to a story of our family where when passed, he had all this land back home in St. Vincent. We're from a small island. I know you guys are big island people, whatever, but we're from St. Vincent and the Grenadines. And one of the things we have along those islands, we're, heirs are descended from people in the islands. And, that's something very important to know is that we have to get a handle on that back there because if we don't, then we have to fight. And that's what I had to do, fight to get through that probate process down in that jurisdiction in the Caribbean. It's a whole different, dynamic down there, and they really take their time. And it's, they tell you need this number of papers, these documents, and you go and you get everything notarized. You go pay all this money and get everything, and you get it all the way down there, do DHL and all that stuff, pay $60, $70, get it down there and hope it gets there without being opened up first and all this stuff. And then they say, oh, well, you also need this. And so, going through 3 years unnecessarily because everything wasn't spoken about, we didn't have these conversations. It wasn't normalized. And I think that's our challenge. To Kay's point, why are we losing wealth? Because we're not making this a normal part of our lifestyle, of our family lifestyle. So I just wanted to add that it's so important to be aware overseas and in other states, all over, and have these conversations. So important.
I have a question.
Sure.
Hi, hi, how you doing? Hi, everyone. My name is Joseph. I have a question. I have a family member who has property in New York. They're actually living here in Florida. And in terms of being the probate process of setting up a trust and just everything, is it whereby even though they're living here in Florida, the property is in New York, should it be where they consult um, a trust and estate attorney here, or how does that work in terms of setting everything up so that the trust for that for those assets with the property and so forth that they have can be set up the proper way? How does that work in that aspect? Is it where they would have to consult someone here in Florida, or is it someone in New York?
So, being a resident of Florida, he would or she would sit with an attorney here to discuss his or her estate planning needs here in the state of Florida. And that would extend to any properties outside of the jurisdiction. So I have clients who have property in Israel, Europe, Jamaica, the Caribbean, all over the Caribbean, and all other states as well, including New York. So you can have a trust that is created for a Florida resident, covering that Florida resident, but extends to property outside the state, depending on how they hold the property and they intend to continue using the property. We'll get into details as to what's the best strategy in holding any property outside of the jurisdiction. Now, they may favor certain strategies, right? Or they may prefer to gain the protection of a certain jurisdiction, right? So that might be a discussion that needs to be had. But I'd absolutely recommend that they start the discussion with a Florida attorney if they decide that it's important for them to gain certain protections in the state of New York, and they want to do a structure there then we'd be happy to refer them to someone there in New York who could do that for them.
Thank you.
And
Sure.
Joe, if you need Merlin's information, I'll share it with you.
I have
Yes,
a
yes.
question. What if it's the reverse? They live in New York, but they have property here.
Right.
They
So
don't have a trust. Well, how would they structure that?
good question. So if they reside in New York, I'm hands off, right? Irrespective of the fact that they cannot, irrespective of the fact that they own property in the state of Florida. I have jurisdiction over the property, but if they're trying to protect it in a trust, that trust has to be established where they reside. Now, if for some reason they want to do for example, a land trust, right? A very unique trust specific for that property. If that's all that they're trying to do, yes, we can do that here in Florida. Again, it depends on whether or not they wanted to gain the protection of certain, peculiar natures of a certain state or jurisdiction. They'd seek counsel from that attorney in that jurisdiction, right? So if it's in the reverse, the same thing applies, right? An attorney in New York would counsel them with regard to any specific needs there in New York. If they want to use some strategy that's unique to Florida, let's say a land trust, they would have to speak with an attorney in Florida.
Good information.
Or someone who's licensed in both jurisdictions. That's a trump card right there.
One more question. I just thought that person has a will. And I know we just mentioned a little while ago that, beyond a will and, and all the other vehicles, is it whereby it is pertinent to have something like a will beforehand, before setting up the trust, or is it something whereby it's just an addition into the putting into the trust as the overall protection?
Okay, so we spoke about the misconceptions of what a will can and cannot do, right? Last time we met, and I hope I get everyone's participation in this when I say it. Where there's a will, there is a
Wait.
way. No, a probate.
Probate.
Where there's a will, there's a probate.
There's a probate for sure.
Right. So look. Next time I say it, you guys need to just spit it out. Right. So yeah, where there's a will, there's a probate. So if you have a will, that's a good start. We now know that you want the house to go to Johnny. Well, that's great. You've made that statement, but you're not here to transfer that house to Johnny. Right. So we're gonna have to take this will and administer it in a court and go through the probate process. And Johnny may or may not get that home. Right. So it's really up to the circumstances at the time, how the property was held and all that good stuff. And that the assets that you intended on passing may or may not get to the people that you wanted it to go to. And that's the risk of a probate proceeding. So I would actually, someone shouted probate. So I would actually recommend that the person get a use a different structure. My preferred structure of trust, right? But use a different structure other than a will. Now, is it wrong that they created? No, there's nothing wrong with creating a will. You can create a will, and like I said, it's a good start. And once we do the trust package, we'll actually replace that will with what is called a pour-over will, which helps to avoid probate. And you'd have to then, per the Florida statute, destroy that will.
Thank you.
Sure.
Thank you. So I'll remember that from now on, because I was thinking where there's a will, there's a way.
There's a probate hanging out somewhere.
Good. There was a probate. Great. Does anyone else have any other questions before we wrap this up? I know Marlon and Julia, Melissa, Karen, Simone, we'll talk about this hours and hours because this is something that we're all passionate about. So I want to be respectful of everyone's time. Does anyone have any other questions, comments? All right. Oh, my mom is on here. Mother,
Oh my God.
have a question. Let's hear it. I'm ready. Let's go. Hi, my beautiful mother.
Okay, I'm trying. Can you hear me?
Yes, we can hear you.
Oh, okay. I just want to make sure I'm not too much of a computer savvy person. Um, my husband passed away about 5 or 6 months ago, and I have this big house, and I'm undecided, but I kind of like want to leave it with my kids, but I don't know what to do. So my daughter gave me ideas, but I talked to Mr. Marlin a while back. So I want to leave it as a legacy because he built it. It's a 6 bedroom house. Um, I want to get with Marlon and do that. So I don't know how to start to do that, or sell. But because I listened to Marlon saying leave something behind as a legacy. So, Mr. Marlon.
Marlon's going to tell you to hold on to real estate, and as your daughter, I'm going to say sell it. So let's hear it, Marlon.
So believe it or not, Miss Carolyn, I'm a realtor too, right? So I have a different opinion with regard to real estate. I think I'm a buy and hold guy, right? So I would counsel you to hold on to the property, irrespective of the fact that I might have an incentive, or Kay might have an incentive in getting it done. But I personally think that I've seen literally I've seen clients purchase properties or build properties for tens of thousands of dollars that are now worth millions of dollars. But it takes time. But in Florida here, it doesn't take a whole lot to create wealth. Just purchase a home or two, right? Because the the rate at which we accumulate wealth in Florida because of real estate is tremendous. So I wouldn't, I wouldn't sell the property. I wouldn't advise it to sell the property. Of course, it's up to you, what you should do and your set of circumstances. If you maybe give me some more details as to what you're going to be doing and how you're going to be transitioning and all that good stuff, maybe I'd give you a thumbs up. I've sat with clients who I've given them that counsel, and they've convinced me that it's the best thing to do, and I agree with them, right? So my personal preference, not legal advice, is I keep it, right? Because of the advantages that you have. It's an awesome thing to know that, especially I'm from Jamaica, right? I'm from the islands. Awesome thing to know that sometimes that you can go back to the place of your birth and there's a home there waiting for you. It's an older home, right? It's been in the family for generations, but there's something there that you can always depend on. If that's something that you want to leave as a legacy, sure. Why not? Keep it. I'm moving on. There's so many ways that you can liquidate that asset without having to sell it, right? There's so many different ways, and I'm not talking about just a mortgage, but there's so many different ways that you can liquidate that asset without having to sell it. I'm sure Simone has some good tax ideas with regard to that as well, right? But I again, my personal preference, I would keep it.
There's a lot of pain, I guess, right now because it's new and fresh. Um,
I get that. So
which talk to you about, you know, the house. And it's just me and my granddaughter. I had my grandson. It's just the two of us in this house. And it's too big. I tell my daughter that. And she has so many awesome ideas, but I don't know which way to turn.
I'm gonna give you my final advice. My final advice is you listen to Kay because I trust Kay.
That's what the
Right.
list is.
And
I was gonna say listen to Marlon. I second that.
I am speaking out the side of my mouth because I experienced something very similar to you, where my dear sister-in-law died in my house in Georgia, and the pain was tough. And I know what you're going through. I personally know what you're going through. And my father-in-law was there, my mother-in-law, we all lived in the same home. And it happened on Father's Day, right? And her parents, all of us, just kept on commiserating over, little stuff that we'd miss her doing, right, in the home. And there's just no way we could separate the home from her and her from the home, because she was such an instrumental part of the home. So we moved and we sold it, right? So I'm speaking out of both sides of my mouth right now, right? So if you again sit with me and you give me some your reasoning and your rationale, I might just side with you, right? But
I need help.
but I think Kay, why I said that you should listen to Kay. I think she's very close to the details.
I think she's waking up. She can't hear you, Marlon.
But I need help. I need help. I'm making a decision. I hear I have my granddaughter. I need this, like she's 16. We had him for 11 and a half years. This, and I don't have stuff set for her. So I was still on I need to get with her too.
Yeah. I will say this though, not to cut you. I mean, if it's been your primary home for more than 2 years, you do get to offset. How many years?
Wait,
30.
Mother, I think you can't hear us.
Okay.
Yeah.
No, I think she said 30 years.
30 years, yeah.
Oh, okay.
Okay. Because now what happens is, you get to offset $500,000 in gain, potentially, because, seeing as your husband has just passed, you get to file qualified widower for 2 years after his passing. After 2 years after his passing, you don't get that status anymore. You go to single. So then you can only offset $250,000 of the gain. It's a big difference. So you need to make a decision within 2 years whether you want a $500,000 gain offset. And then, I mean, just thinking tax wise, if you then passed it on, it will not be their primary residence for 2 years, right? Because you would have passed it on to them. And then so the tax implications for them might be a little bit different, depending on how you pass it on when you discuss that with Marlon. But just from a pure numbers perspective, if you were up in the air, right now at this stage, you do get to offset 250,000 each for capital gains when you sell. So, you want to make sure that you talk to us within that time period just to make a decision.
I have another scenario that's kind of similar, right? My parents' home here in Florida. My mom has stated that she would like the home to be here, not to be sold, right? So they're both alive, because she wanted to remain a family home for anyone in the family that I guess might run into a situation or need a home at some point. But then who maintains the home? Whose responsibility is it? Because a family home unless everyone is going to agree, and they might not agree because my siblings don't even live here in Florida. So it gets a little bit complicated, and they're not deceased, so maybe I'm being, but that's her wish right now.
That's a tough one. I mean, I have tons of ideas with regard to that, but it all depends on the dynamics within your family, right? And going back to what Julia stressed on, the need for open discussion about wealth and how we're going to be taking care of wealth. I'm not sure if a part-time rental is an option that would, help to create some income to support that. I can even jump on some of the things that Simone said with regard to accounting. I actually have 6 different components that in every business that goes to 6 different bank accounts that would be separated out so that we ensure that profits are first and investments are taken care of. That could be the same scenario with this home, right? Where you put it in a trust or a corporation, or you rent it out. It creates income on its own, profit first, have those separate accounts where it in it of itself, that property in it of itself is spawning other properties. Use that profit first principle with regard to what Simone was discussing. You have enough saved over time to purchase a second rental and a third, and so on and so forth, and just keep on compounding on itself. But that again would have to be a discussion amongst the people in your family that has that vision, embrace that vision, have that dynamics going on. So it wouldn't be a financial burden on either of you guys if it's structured and done properly, and quite frankly treated like a business, right? So
we got some time, right? They're still alive, so we got some time.
Yeah, and you can use the
absolutely.
life insurance to fund a lot of this, a lot of those operations.
Right.
That's life insurance right there. That's where that comes in.
Right.
And that's where you form that trust and we work together. It's a collaborative effort, multifaceted. So yeah, the life insurance, you can leverage the proceeds out of that. You have a trustee you have an agreement, and you agree that certain portion of the proceeds will be used to the upkeep and maintenance of the property. I mean, all those things are the responsibility of the trustee. So yeah, it's so much you can do, so many creative solutions for these situations.
And that is one question I had, Simone, when you were talking about, the BYOB, building your own bank, being your own bank. And you were saying that you could use, I want to say, your life insurance. Well, if you're using your life insurance, you can use S for collateral, your life insurance policy, right? Can you use your home as collateral if you're doing that?
Some institutions will, but if you have a loan on it, sometimes there are stipulations because whoever has the loan has to have first right of way. I don't know what the correct terminology is.
Yeah.
And most people, if you're going to use it as collateral, they want to be first in line. They don't want to be second. So a lot of the times, if there is a loan involved already, it's harder. If you own it outright, yes, you can, they'll tend to take that as a collateral for sure. Yeah.
Okay. Good to know.
Okay.
This has been awesome. Thank you guys. Like, I'm really excited about it. Like continuation of it. And so I would like to ask you, with Thanksgiving coming up and we're, going to see our family. Karen, you may see your family and start this conversation, right?
Yeah. They'll be here after Thanksgiving for a few weeks. So yeah.
Okay. So what advice, and I always ask this, Marlon, what advice would you give to forge that conversation with your family during the holidays, because it's the season of giving, and it's also a season where people have lost loved ones too. So it's kind of like, you know, mixed emotions. So what advice would you give to start having the conversations? Marlon, I love what you were talking about with your son, you know, and where he is. Sounds like he's like definitely on the right track. But what would you say to your family members, like when it comes to wealth building and just, you know, legacy planning?
So I just speak to the reality, right? Speak to the reality of where we are. I know it's kind of a buzzkill. Let's eat some turkey and talk about death, right? So and passing on wealth. It's kind of a buzzkill, right? But I'd speak to the reality, right? We're here at grandma's home. It's awesome that she's been doing this for years. It doesn't seem as if she's moving as fast as she used to. Let's help her out, and so on and so forth. What do you think is going to happen with regard to, do you think she's have everything in place? Do you think we should sit down and talk about these things? You know, and that's kind of tipping around the subject a little bit. I prefer the direct approach. Guys, we're literally not going to be around for the rest of our lives. What are we doing? What kind of plans do we have? Do we want to see a vision for this home? Do we want to see a vision for the family? Let's talk about corporations. Let's talk about taking the block back. Let's talk about making sure that we're pushing the family further into to wealth creation, wealth and generational wealth. An idea was suggested to me once, and I didn't follow through on it, but I think this is something that if I share it with you guys should take a look at doing more discussions like these on Zoom, right? With your family, right? So have these coffee and wealth planning discussions. Let's have a little bit more direct discussion about how we're going to be taking stuff from the next generation, and how we want to make sure we avoid probate. Want to make sure that we continue what they built on and not necessarily destroy it. There is no one path. Each family is unique. You should be able to read the room and understand that Johnny doesn't respond with the direct approach. Susan might be a little bit more open to that. Read the room and try to strike a common chord that would hit everyone and bring them home to the fact that, look, we see grandma, she can't move that much anymore, and we're here helping her out. What are we doing? What are we doing next? The thing that really, I wouldn't say it woke me up, but the thing that really hit home for me was, I told you about my sister-in-law, but we took the entire family back to Georgia, back from Georgia to Florida, and a few years later, my mother and father-in-law passed within a week of each other. That was tragic enough, but coming to the realization that my wife and I are the next generation, right? That's going to be passing on, and that hit home for me, right? So just like Simone, I got to be about that business, right? I got to take care of that business, and sharing that sentiment with others, letting them know that we should be focused as a group, not just as an individual, not just as this nuclear family, but the extended family. We need to be focused in that sense. No more GoFundMe's, right? No more we gotta make that commitment.
No more fish fries.
No more fish fries, right? We gotta make that commitment. No more surprises, right? With regard to these things. We planned this. It was all taken care of. I know folks who literally picked out the dress that they're going to be buried in, right? So, you got to be that particular. You got to be that deliberate. right? So you make sure that you are having this clear, frank discussions. I don't know what's not what's wrong, but what's so unique about the human psyche is we know that this is a temporary state, but we live as if it's not going anywhere. And that's a beautiful thing about life. But we can't allow that vision to affect the reality.
I think now is the perfect time. There's so much death in the world and destruction. I
Right.
think it's easier, it should be easier to have these kind of conversations because it's right in our faces every day. Every day.
And also with what Marlon just said, because of the prior generations not having a blueprint, I think that we, our generation, have have the work to do so that you can set the path for the next generation, because it's only going to make our, let's just say our people, do better. Because why? Because we knew a little better, so we set the course. So that means that the younger kids, they're gonna do better. So versus thinking that these things are taboos, oh, you know what, mom and dad saw, okay, what grandma and uncle didn't do, they set us a little, they started talking about these things, and we got more educated, and it was common language for us. So with them, it's gonna be like next to nothing to set up a will and a trust, and talk about investing and understanding these things. You know what I mean? And it just has to be that way. Like Marlon says, you just have to just keep the conversation going so that the next generation is just they got it down cold, so it's nothing to them, just like everyday TikTok or whatever it is. And we consistently need that. You have communities, they forge a whole, meetings monthly. Hey, who's getting married, who needs help, who needs that? We can do that. I think that if we all do that within our family, other people
Exactly.
within the other family start looking at, oh, cousin so and so's family, they have a family meeting every month, and see, okay, who's struggling financially, how is everybody's credit score and whatnot, and so forth. And then it goes on and replicates, and hopefully the race, who knows where we will be at in a couple 100 years.
And I'll add to Joseph and say, just bringing in my tax side, if you have a company and you set your company up with your family as your board of advisors, when you have these conversations, take a vacation and write it off. That's all I got to say. That's it. Just make your
I
family
agree.
a
I
piece,
agree.
a part of your board of advisors. So when you have these meetings, should you choose when and where, you now have a tax write-off, right? So the IRS says if you do more than 4 hours a day of work, you get to write off the whole day, which means meals, food, entertainment, everything in between. And this is how wealthy
You,
people do it. Make sure you do it too.
I love that.
yeah. Okay.
I love that. So does anyone else have any other questions? Oh, Julia, we didn't hear from, oh, Julia and Simone. Going back to my original question, you want to go? Well, I love your advice, Simone.
Yeah.
The family meetings. I wrote
Okay.
that down.
Oh, so okay, so I definitely agree with what you all have said so far about this and how to raise that topic. And I think just when we're watching the news, I mean, that alone, like we've already kind of alluded to, that
Mhm.
alone can raise the, trigger that conversation. Wow, that bad accident, those kids on the way to that in Ohio, the semi trailer hit the tractor trailer hit the school bus, and that was it for several kids and people involved. I mean, we're having tragedies every day, and then it doesn't always have to be like a grim conversation. It could be, hey, look, I mean, I'm just pulling something out the air, but look at the Rockefellers, or look at, these different businesses, Nordstrom's, I think that's a family business, or there's different businesses that were passed on from generation to generation, that we are enjoying the fruits of their labor today. So maybe even drawing some examples from that, the empires that have been built because there was planning involved from around the table. So we can do it in a positive light as well. And I think really maybe that, to have a balance between, mortality and immortality, so to speak, through legacy, being a legend in your own family, I think that is helpful.
Right, be a legend. And like Joseph said, set the course. That's sums it up, set the course. And it only takes one of us, it just takes one of us. So Renee, do you have anything you would like to add? Joseph, I so appreciate you being on here as well.
No
Karen,
problem.
you guys are amazing.
I learned a lot today with information. So I'm glad I jumped on tonight.
It's past your bedtime.
Oh, you know that.
So thank you for staying on this long.
But who's the gentleman, Joseph?
Yes.
I like that what he summed up about people getting together for Thanksgiving, and Marlon as well, and checking on families. And I just believe that this home is a legend for my husband. He built it for his family, and I want to keep it, to to remember him by. That would be good.
So Marlon, I have a question in regards to that, and we'll wrap it up seriously. Should my mother decide that she never would she establishes her trust and she never want the home sold, can that be a thing in the trust? Like she like it to go generation to generation? How does that work?
Sure. She could craft it where the house is not to be sold. Yeah. That's a short answer. Yeah. Absolutely. The beautiful thing about a trust, you have that power within a trust. And the thing about it is, she's creating she's more than likely going to be creating a revocable trust. And with regard to that, once she passes, the trustee has to, unless there's some serious extenuating circumstances, they have to adhere to her wishes, right? So once that decision is made and she didn't modify it before her passing, it is what it is.
I wanted to add something. As some of you may know, my mom passed a year and 2 months ago, and she did create a will, and I'm grateful that she did do that. But what we were missing is her expectation. So I encourage any and everyone that listens to this, sit down and have that conversation on what your expectation is for your children. What do you want that to look like? My mom left her home to 4 of her children, and we didn't know what the expectation was, and that's where we ran into a problem. So just some advice for Miss Carolyn, and I believe it was Karen. If you sit down and have that conversation on what the expectation is of leaving that legacy, that home, what is it that you want to happen to it? Because that's where we ran into problems. Yeah.
So let me ask this question if we can end this. If the children don't want the home, so I mean, in fact, they don't want me to leave the home, so I might just sell it because I feel like it's a legacy for my husband because he built. It was a regular 3-bedroom, 2 baths. Now it's 6 bedrooms. He built it, and 4 baths, and 2 other rooms or 3 other rooms. So I wouldn't have no other choice but to sell it because they don't want the
What
home.
about the grandchildren? Not just the children, but what about the grandchildren?
The grandchildren are, I have
Yeah.
older set grandchildren and I have younger sets. So nobody really comes around for me to really discuss. The only one that I really talk to about that is my daughter, my sons. Nobody, you know what I mean?
Mhm.
So I feel like Thanksgiving would be the good time to discuss that, you know.
We'll make it.
Miss Carolyn, something else I wanted to say because it keeps ringing in my ear, so I have to say it.
Oh
You
no.
have to do what's best for you, and I wish
Mhm.
my mom did that. I'm not a lawyer or an attorney. I'm not an accountant. I'm not an expert in any of those fields, but a life advice: do what's best for you.
Because she sounds conflicted. She really,
Yeah.
her voice is saying she wants to leave this home. That's
Mhm.
what she's saying. I can feel that.
Yeah. Do what's best for you
Right.
I don't
because
mind.
we can't live for our children. Like I said, after my mom passed, we realized that the four siblings, it was a 3-1 on selling my mom's home, and it was a lot of conflict. Unfortunately, we end up having to sell it, and even though it wasn't a good thing for me, it did start me on a journey to create a trust for my children and sit down and have a conversation with my children and let them know that I am leaving them a legacy. But I am what I have is theirs, and we're going to build it until I transition. So it did lead to another conversation, but I wish that we had the conversation before. And
Yeah.
I strongly encourage you, Miss Carolyn, to do what's best for you.
Right.
Because at the end of the day, you have to be happy. We're here for what they say, a good time, not a long time.
Not a
So
long
you have to
time.
do what's best for you.
Yeah, Melissa, you're my shining star.
Yes, honey. But
That's my girl.
I have
Yeah,
to pull it together because I'm still grieving over my husband. So I got to put a lot of things together. And
yeah,
then um I can do that. Um, you know, and I'm just not trying to just keep harping over the house. It's just that I know if I go somewhere else to live or sell a house, I'm gonna always think about this house because, he built it for his family.
you all built it,
Yeah.
but
Mm,
you all built it, and we appreciate. And yeah, it's a lot of mixed emotions.
oh, I know. I'm sorry. I'm sorry, y'all. I just,
Don't be sorry.
Okay.
You're good.
I just,
A lot.
um, I'm just a little afraid right now. So I'll put it together.
We got you. You know that.
Yeah. I believe everyone on this call has experienced grief, and it doesn't go away, it just gets easier to handle.
Right.
So I
Okay.
pray that you get there, you know,
Mm,
so that you can have a clear mind to make a decision that's best for Miss Carolyn at the end of the day.
Yeah.
Thank you so much for that.
You're welcome.
'Cause they have like 22 grandchildren. There's a lot of them. So
And we was married 42 years, so he was like my I
32.
can't. We used to go everywhere together. Right, I mean, right, he takes me everywhere, and now I feel afraid. My daughter said, "Mom, come to Port St. Lucie." I'm like, "I can't." Yes, you can. But I end up driving when I go to church or something like that up there. But yeah, but she's been in my corner. I can say that. But I love that beautiful lady. She been in my corner. But everything I'm struggling with, she's been there. And my other family, they was very supportive when my husband died. They beautiful. I just love my kids, all of them. They was I never seen such amazing children in my life. I'm like, wow.
That is the
And
one
the
thing I can
grandchildren,
say with Pops passing away. There were no, like, how many siblings?
oh,
Seven.
the children, even
We,
the
I-
5-year-old, she still go, my papa? Is he
yeah,
my papa? I'm like, oh my God.
yeah, that was a blessing. And I'm grateful for that. That we had
He was
no,
a man. Well, his way, but he was loved by all his children and grandchildren.
Yeah. That's a
Okay.
blessing in itself.
Well, I am going to wrap this up. I appreciate you all so very much. This is 2 hours. And
What?
it doesn't feel like it, right?
Like
You know,
it.
my bedtime. Oh,
It has been 2 hours.
Uh,
And Julia, you have your story too. That'll be a little bit beyond 2 hours. I think everyone has a contribution to, you know, that part of life and the loss of a loved one. I pretty much know everyone's story, and I dare not share unless you're willing to share. But it's all powerful because it gives us a game plan. And like, I'm gonna go back to what Joseph said, like we get to set the course for the next generation. So that's what excites me, and it's power in your legacy. And Julia, what you and I talk about in becoming a legend. And even though this is small and intimate, I do believe and I have faith that it's going to grow as we continue to have these conversations, because it's a lot of people out there we haven't even reached yet. And so, again, I thank you all just for being here and sitting throughout this, gathering of fellowship. It almost feels like a fellowship.
And
Yeah.
thank you, Kay.
thank
Thank
you.
you.
and
Thank
want to
you.
thank
Thank you,
God.
everyone.
I met
Thank
you all.
Kay.
Thank you for sharing, everyone.
Blessing.
Thank you.
Thank you.
Absolutely.
And God just keep you all and safe.
You as well.
Amen.
All right. If I don't see y'all again, y'all
Yeah.
have a happy Thanksgiving.
You as well.
Have a good night.
As well.
And I'll get with you all so we can start planning for 2024.
Yep.
Okay, that sounds
That's
good.
Good.
Bye,
All
guys.
right.
Thank you, sir.
So, happy
Good
Thanksgiving.
night.
All
Care.
right. Talk
Have a good
soon.
night.
Okay, good
Good
night.
night. Take
Good
care.
night.
Hey,
Miss Kay, I'm sitting in here screaming, where were these people 10 years ago?
right? Like, oh my gosh.
My goodness.
Girl,
But
my
that was
life would have been-
amazing. I'm sitting here and I was trying to get Brandy in here, but she watching her Heat game. But I would love for her to meet Simone.
I love Simone. Oh yeah, because she's a CPA too.
Yeah, well, she's not a CPA. She has her
Accountant.
degree in accounting, but she's actually going back to school the next, whatever the next
Wait, wait,
semester
wait.
is.
Stop recording. Stop recording. Pause.
Oh, sorry.
Stop. Girl. But listen, you're gonna have to remind me, like, start recording, stop recording.
It's still recording.
Oh, I'm so bad with this. Good night, everyone. Happy Thanksgiving.
Go. Yeah, I really wanted Brandy to just see, a CPA, black, young, just doing it. You know what I mean?
Yes.
Yes.
This is
If
good.
she
Like,
wasn't so far, I'd be like, Brandy, you're gonna go intern over there.
well, that's right. And Marlon referred her. So this is all like so coming together. And I am excited because I know I was so nervous about this, especially when Julia couldn't do it anymore because she needed approval from